CNBC TV 18, celebrating 15 years of leadership.
Our top story tonight, the Bears are back with a vengeance on Dalal Street. The SENSEX tanks over 850 points to mark the biggest single-day fall in nearly 5.5 years. The Nifty sinks over 250 points as crude oil and global jitters wreak havoc.
There's simply no stopping the crude free fall. Oil prices plummet to fresh 5.5-year lows as Saudi Arabia cuts prices for European buyers. WTI falls below $50 a barrel. Brent tests $50 before a marginal rebound.
A roller coaster ride across Europe. Equities recover in tandem with oil prices to reverse most of their losses. Stocks on Wall Street also rise in early trade.
The back and forth over 3G spectrum continues. The telecom department rejects the regulator's proposal over reserve price. Sources say the DOT wants the price to be nearly 3,900 crore rupees. That's 43% higher than the price proposed by the telecom regulator.
The government shelves its plans to move ordinances to amend the Mines and Minerals Act for now and the Arbitration and Reconciliation Act as well. Sources say changes to both these laws likely to be made through amendments in the upcoming Parliament session. That's a CNBC TV 18 exclusive.
India is staring at a pension crisis, warns the rating agency CRISIL. The burden will rise to 4% of GDP in 15 years if India's growing population of senior citizens are left out of the safety net.
The Special Investigation Team on Black Money seeks amendments to strengthen the Prevention of Money Laundering Act, and the Foreign Exchange Management Act also asks the government to give more teeth to the Investment Directorate. That's another exclusive.
Clarity on tax and FDI policy takes center stage as India Inc. meets Finance Minister ahead of the budget next month. Industry also pushes for removal of minimum alternate tax on manufacturing.
Absolutely magnificent. Dovey finishes off in style. A magnificent strike into the crowd. India lift the World Cup.
Well, the BCCI has named 15 warriors to defend India's World Cup crown, but no place for the last World Cup hero, Yuvraj Singh, and others like Virender Sehwag and Murli Vijay. Good evening. Thanks very much for joining us on India Business Hour. Nantara, are you surprised at all by that squad selection?
Well, we're going down under to Australia and New Zealand, so I'm not surprised that we've got 5 pacers and 3 spinners. However, surprised or shocked, however you want to read it, as some of them like Jadeja and Stuart Binney making the final cut.
All right, Yuvraj Singh out of the squad, but perhaps that was the expected. Eyebrows will be raised over the inclusion, as Nantara was pointing out, of Stuart Binney. Also Jadeja, Ishant Sharma recovering from injuries. Will they be fit on time? The board certainly hopes so. But on the day the World Cup team was picked, the Bulls were clean bowls on Dalal Street as the Bears are back with a vengeance. That is, of course, our big story this evening. Carnage on Dalal Street, falling crude oil prices and fears of Greece exiting the Eurozone, sending shockwaves across global markets, and India was no exception. The Sensex plummeted over 850 points, falling below the 27,000 mark. The Nifty lost over 250 points, and there was really no place to hide as the sell-off was broad-based. Mid-caps tanking in trade, with the index losing nearly only 385 points. Now, let's put things into perspective. This is the biggest single-day fall in absolute terms since July 2009. That's 65 months ago. And the biggest percentage fall for the indices since September of 2013. That's 5 months ago. And from our research team, we're now joined by Anuj Singhal, Varinder Bansal and Nigel D'Souza to pick up the pieces of what has been a terrible Tuesday for the Wall Street. Anuj, let me start by asking you, it was an incredible collapse that we saw in our markets. What were the key triggers? Yes, global factors, and yes, overnight we saw the global markets tank, but was that really the key trigger?
Indeed, a big collapse led by global triggers and some technical factors back home in India. So the market started with big global cues. The US market was down, crude was down, Asian markets were down, the volatility index was up, and the market had the first fall. And then the market broke that crucial support zone of 8180 to 8200 at some point post noon, and that is when stop losses got triggered and the market had that second level of fall or second round of fall, which took the SENSEX down by nearly 900 points and almost 3% fall on the Nifty. What was most damaging to the bulls was that it was a secular decline. No particular stock or sector led the market. And let's take a look at some of the stocks that dragged the market. And if you see the top 6 Nifty losers in terms of contribution, they were all sector leaders in their particular sector. So you had ICICI Bank, HDFC, Reliance, they were all down about 4%, all dragging the market, the Nifty by 20 points or so. Then you had ITC, L&T and TCS. So no single stock contributing, but all stocks put together contributing to the Nifty decline. Not just that, take a look at some other stocks in today's trade. Tata Motors, ONGC, State Bank of India, they were also quite lower in trade today. In fact, ONGC is now approaching panic level, 6% lower on that particular stock. On a day like this, high beta always gets a knock, and that's what metals did. So Jindal Steel, Sesa Sterlite and Tata Steel, in terms of percentage losses, these were the biggest losers, though they don't count for much in terms of Nifty weight. Now let's talk about some mid caps. Again, high beta would dominate space there. Indiabulls Real Estate, HDIL, Unitech, the Realty Pack was all down about 6%, and some other prominent mid-cap losers included stocks like IFCI, JP Power and mid-cap banks led by Andhra Bank. That was down about 5%. So for now, it looks like the market is in a corrective mode, and maybe we'll have some more weakness over the next few days, unless, of course, there's some stability in the global markets.
Anuj, hang in there. I'm going to come back to you. We will discuss the way forward in just a bit, but market watchers have not lost hope yet. In fact, many believe that today was just a one-day blip, and then again, that view is not unanimous. Let's listen into some market opinion.
Look at 27th August last year, the BSE SENSEX on that Black Tuesday was down 590 points. The Nifty closed at well below 5,300. The rupee touched 66 to a dollar, sparking rumors of a total run on the rupee all the way to 80, which is what pessimists would have you believe. The Indian 10-year benchmark bond yields spiked well over 8.5%. And cut to where we are today. I think we are in a far more benign position, purely from an economic standpoint. Then, 27th August 2013, crude was at $107. Today, crude is at just a shade over $50. And I think, there's no dispute on the fact that we are going to save 60 to 70,000 crore by way of subsidies.
I really can't put together a number which kind of takes me to 7,700. I think we would get reasonably good support in the 7,900, 8,000 range in the immediate future, unless obviously global markets get worse and the entire currency equation goes out of toss for the whole emerging market basket.
What we hypothesized on the last day of the last calendar year was that the market is going to make a new high in this complex correction and then go down below 79.50 that we saw in December. But apparently it turns out it's not going to be the case. But it looks like it's going to go straight below 79.50 and then find a bottom somewhere close to 7,700 or just about that place.
Given my positive outlook on Indian inflation and the likelihood that the trend in Indian bond yields and Indian interest rates is down, therefore investing in sectors and companies which are sensitive positively to lower interest rates and a lower inflation environment. Those are the sectors that you want to focus on.
Well, Robert Parker there, one of the market watchers that we've been speaking to, not perturbed by the aggressive sell-off that we've seen today. But Anuj, coming back to you, what does this imply now for the days to come? Are we in a bear market, or is that too strong a word? What should investors be looking out for?
Indeed, so bear market would be too strong a word to use, but in terms of trends to emerge for the market, I think there are few trends that quite clearly emerge now. One is that you need to keep watching the global screen, but apart from that, domestically, this market may well have made a peak in January. That was a call of a lot of people that January would be a rough month for the market. The last 4 or 5 days, looked good, but the volumes were lacking, and today you had decent volumes. So 86.20, the all-time high, becomes a peak for the market. What next to watch out for? Mid-cap stocks. The mid-cap index till yesterday was at a new, almost at a new lifetime high. Do these stocks now start to underperform? Because, as I said, they have outperformed quite a bit. That's something that we'll be watching out for. Bank Nifty was up 25% in 3 months before the fall started yesterday. That's something that we'll be watching out for domestically. What else? FII volumes, because over the last few days FII volumes went missing because of the holiday factor. They will be back now. What kind of allocations are being made to India in the month of January for the year? That is something that we'll be watching out for. That's going to be important. The most important wild card for India would be currency, because in global dollar strengthening, the Indian rupee has still been resilient, and that's something that will be tested over the next few days or months. And again, earnings season, that becomes hugely significant starting from the 9th when Infosys will come out with numbers. So that's something we'll be watching out for. But really, the biggest trend for me is that the market may well have hit a near-term peak at that 86.20 and may well have resumed its correction, the 10% correction that we spoke about.
So bulls are running for cover, but like Anuj is pointing out, perhaps too soon to say it's a bear market. Thanks a lot for joining us with that analysis. And as the markets witnessed one of the strongest falls over the last 2 years, several stocks hovered close to their 200 daily moving average. Varinder Bansal joining us with his list in hand. Varinder, which are the most vulnerable stocks?
Well, thank you so much. I'll be focusing on the stocks, which are technically weak, and especially which are trading very near to the 200 DMA mark. This is a list of stocks which are very near or have fallen below 200 DMA, which clearly means that they are more vulnerable if more fall comes from here. Look at Reliance Capital. That stock was down nearly 6-7%, but is now trading 4% below 200 DMA. SAIL, Hindalco, Bharti Airtel, Wipro, all these stocks fallen below 200 DMA today, clearly indicating technical weakness. Watch out for stocks like NTPC, GAIL, Idea, ITC. They are the ones which are just trading at 200 DMA or 1 or 2% above 200 DMA. So it will be very important to see whether they sustain the 200 DMA mark or not. But here's a list of companies which are trading anywhere between 2 to 9% away from 200 DMA. And it'll be important to see whether they will be selling or buying comes from these levels. So watch out for them very, very closely. Power Grid will be one stock to watch out for. Karnataka Bank, Tata Motors, Bank of India, Allahabad Bank, Havells, Arvind, HDFC. Most of the financials named here, but in the mid-cap category, Havells and Arvind could be very important.
All right, Varinder, thanks very much for spotting those stocks for us. Now, the last time we saw carnage of this magnitude was on the 6th of July 2009. So how does today compare with that disastrous day, which was about 5.5 years ago? The macro picture, not just in India, but globally, is completely different. Nigel is here with the analysis. Nigel.
Well, it was a horrid trading session just in terms of market capitalization. The NSE listed stocks lost close to around 2.7 lakh crore in terms of market cap. But just take you back and see that in terms of the absolute losses on the Nifty as well as on the SENSEX, it's around the 7th to the 8th if you just term it in terms of the total absolute loss. This time around as well, on the Nifty itself, we were down close to around 250 points, while on the SENSEX, we were down roughly around 870 points approximately. So let's compare it with the last time around, as you stated. So that date, in fact, was the 6th of July 2009. Comparing both those two dates, the base was much smaller. So that time around, the Nifty lost close to around 6%, while this time around, we're down close to around 3%. But the big culprit last time, that's on July 6, 2009, was the Bank Nifty, because that was down a good 8%, while this time, the Bank Nifty on a much bigger base is down roughly around 3%. But let's take a look at the top 5 losers from the Nifty space on July 6, 2009. 2009. So they're up for you on your screen. Reliance Infra, Unitech as well as Reliance Capital, they feature in the top 5 losers from the Nifty. They no longer are part of the Nifty. While a couple of other big stocks are there. ICICI Bank, that was a big culprit that day. It's a big heavyweight. It was down close to around 10%, while Tata Steel as well lost close to around 9%. And Tata Steel finds a mention even in today's losers. So just take a look at the top 5 losers in today's trade. 3 metal stocks are up there. JSPL is there, Tata Steel, as well as Cesar Sterlite. All of them were on the losing end. Throw in a couple of other heavyweights, ONGC as well as HDFC. But there were a few winners the last time around. So on July 6th, 2009, we saw that Ranbaxy as well as IDC, both of them were up between 3 to 4%. But the common factor in terms of winners was Hindustan Unilever. Last time around, it was on the winning end. And this time around, it was a sole Nifty stock that did end in the green. Now, importantly, what happened post the carnage we saw last time around? The Nifty went ahead and corrected another 4.5% odd, but all is not lost, because post that correction, that's post the 5 days, post this big massive fall, post the 4.5% correction that we saw, the Nifty, the SENSEX as well as the Bank Nifty, take a look at what it's done post that big correction. All of them in fact have doubled, and the Bank Nifty in fact is up close to around 165%. So maybe on a positive note, there could be a bit of a bounce back for some more correction in the near term. Back to you.
So torrid Tuesday, a terrible Tuesday. Thanks a lot, Anuj, Nigel and Virender, for joining us with all of that analysis. And here's why we're seeing that massive sell-off around the world. It's thanks to crude prices. Brent crude had slipped to $51 a barrel. WTI NYMEX staying firm below $50 a barrel mark. This, as data shows, output in Russia hit a post-Soviet era high in 2014. Exports from Iraq were the highest since 1980. Saudi Arabia, meanwhile, has cut prices to its European buyers but increased prices for its Asian buyers. All of that triggering a bout of panic selling. But over the last few hours, we have seen crude prices rebounding marginally, and that's why you've also seen the European markets touch the green. For more on this now, we're joined by Amrita Sen, the Chief Oil Analyst with Energy Aspects, on the phone line from London. Thanks, Amrita, for joining us here on India Business Hour. My first question to you, is there a bottom in sight? Do you think $40 a barrel is possible?
I think $40 a barrel is definitely possible. I think in these kind of markets it's extremely tricky and dangerous to a large extent to call a bottom, because the last $20 move probably hasn't been justified by fundamentals. It's very much a panic and a fear that's driving markets at the moment. So the downside, it can continue for some time now.
So you think $40 is very possible. Do you think it can go below that? How much do you think they could head lower to?
Again, you are really choosing just a number at the moment, because these are not justified by fundamental levels. We've seen crude trade in the 30s in 2008, 2009, but like you were saying as well, the macro backdrop is very, very different today compared to what we've seen in the past. It does. I mean, at the moment, the market has been looking for OPEC to cut production, which hasn't happened, and there are no signs that OPEC will be reducing any output. So now the market is reliant on non-OPEC supplies, particularly high-cost producers, to start shutting in production. The problem is that takes time, because nobody actually wants to shut in existing output, because it's actually more costly to do so, even if you're not making money. And that's why I think there's a huge amount of panic in the oil market today.
Huge amount of panic in the oil market. And you were talking about macro triggers, Amrita. We're seeing supply peaking and we're seing demand unlikely to recover anytime soon. So given the supply-demand mismatch and, of course, all the geopolitical back and forth that's going on at this point in time, would it be naive to assume that we could perhaps see a pullback to the 50-55 levels anytime soon?
I think ultimately we'd expect prices to get back into the 60s, even in the short term when there is oversupply. And when we work through that oversupply, prices should climb into the 70s and 80s towards the end of the year. But I think the problem at the moment is that seasonally this is a low period, or you're coming up to the low period for crude demand, because a lot of refineries go into maintenance. And that just doesn't help when you've already built 1 million barrels per day of inventories across 2014. So your starting point is already high, and on top of that you're going to be building more stocks. And I think that's what's really causing a lot of the recent downturn in the market.
All right, so in the short term, the rout continues and it's likely to continue. Amrita Sen, appreciate you speaking with us here on India Business Hour. And a quick check of the global markets.
Well, we saw the price of oil causing that huge carnage across the global equities. Then we did see oil prices rebounding a bit, and perhaps that's why we've also seen the European markets go a little bit in the green. Let's bring up the frontline indices for you so you can have a look for yourself. The FTSE now up by about 0.2%. The German DAX, smart recovery, up by almost 108 points, and the French CAC, meanwhile, up by almost 21 points. Across the Atlantic, let's do a quick check of the US markets. Shares open flat, but now clocking some gains. Both the Dow and the S&P 500 just about in the green. The Nasdaq still in the red.
Well, back home, a day after the Cabinet fixed the reserve price for 2G spectrum, the back and forth over 3G continues. The Telecom Department has rejected the regulator's proposal over a lower reserve price. The Department of Telecom wants the price to be nearly 3,900 crore rupees. That is 43% higher than TRAI's proposal. Malvika joins us now with the details. Malvika, what exactly is going on as far as 3G is concerned? The tug of war continues. We don't know whether the auction will be held in this fiscal, which is what the government said it intends to do. How much a 3G auction is finally going to be put on the block, and now this battle between the DOT and the TRAI over pricing.
Well, the key effect and the impact of this is that companies like Bharti Airtel, Vodafone Idea and Reliance Communications continue to feel challenged because there is no clarity as far as the roadmap for 3G auctions is concerned and the pricing is concerned. Tomorrow there is a meeting of the Telecom Commission where this recommendation of the DOT's internal panel is going to be taken up. But let me point out that in the upcoming auctions, the issue is not that of reserve price. The issue is not that of what that price level would be that the companies could bid for and achieve. But the real issue is that of availability of spectrum. And like we were mentioning even yesterday during the discussion, and experts on the channel pointed out, if only 2G spectrum auction is conducted, there is going to be a very high pressure on companies whose licenses are coming up for renewal. It will be a make or break battle for them in circles where their licenses are coming up for renewal. So they will have to go all out and bid. If the government sort of withholds the amount of spectrum that it is going to put up for auction in the 3G band, then this would necessarily mean that there would be very high and aggressive bidding in the 2G auction. So clarity as far as 3G spectrum pricing and 3G spectrum, quantum of spectrum that is going to be put to auction is going to be very critical. And hopefully tomorrow the Telecom Commission will take a decision in this regard.
Okay, Malvika, appreciate you joining us. The back and forth continues. But to the other big story of the day, as the Modi government gears up to present its second budget, Finance Minister Arun Jaitley today held his first pre-budget consultation with industry and trade groups. During the meeting, heads of industry bodies like CII, FICCI and ASSOCHAM urged the Finance Minister to do away with the minimum alternate tax for the manufacturing sector to boost activity. Industry chambers also pressing for a stable tax policy and a quick rollout of the goods and services tax, also seeking clarity in the government's FDI policy across sectors. The Finance Minister on his part told the heads of industry that government believes the budget is not needed to announce policy decisions as key decisions are being taken by the government around the year. Perhaps a little bit of expectation management there.
The overall atmospherics in the meeting, including the opening comments the Finance Minister made in terms of the economic confidence, the conviction, the fact that there is a growth stimulus which is required in the economy, that there should be restoration of the investment and capital formation cycle, and the de-risking of the infrastructure sector in its entirety. So I think the priorities seem to be fairly well spelled out, and there were very specific recommendations that were made.
What I requested was a rationalization of the tax regime. There is a revenue target that is given to tax officers, and they actually, because they have to attain that, they often use irrational tax demands. The recommendation was that the tax officers should be judged on their performance, not on the achievement of targets. That was one. And the other was that the cost of capital is very high, and we request that there should be some relief on the interest rate.
Well, joining us now to talk about India Inc.'s expectations from the budget is the President of the Confederation of Indian Industry, Ajay Sriram. Mr. Sriram, appreciate you joining us here on CNBC TV 18. You met with the Finance Minister today. It seems that industry organizations like yours have presented a wish list which is more or less similar to the one submitted earlier to the Finance Ministry. Does this mean that issues of interest and priority have yet to be fully addressed by this government?
No, I don't think so. I think if we compare what we did last year, or rather say 8 months back, and what we are doing today, I think there are a couple of new additions. It is definite that in the last 7 months, the government has made changes across many areas. And we fully support the approach of the government, where they say the budget is only a one-day accounting exercise, but changes and benefits to the economy or changes for economic growth can be done every day of the year. So we support that totally. But I think in this year also, if you see, there are some new ideas. For instance, we've recommended that all the NPAs which are there for infrastructure spending, which are given by banks, please put them into a separate corporate entity, and that can then be taken care of separately, like you have asset reconstruction companies. And the bank's liquidity position, the bank's ratios will be better. They can then looking at investments in the future. So I think there are other areas also. We've also recommended, for instance, saying that for the infrastructure growth, can one look at the government taking up the projects for implementation and then giving it to a private company for revenue sharing, so the government recovers this money through the management and the maintenance of these later on. So I think there are new ideas which keep coming in.
Okay, so those are the ideas that you've suggested. But, Mr. Sriram, the recent mid-year review talked about challenges in meeting the fiscal deficit target for FY16. Does this mean that in the coming financial year, the government will have its hands tied when it comes to its own spending program or supporting the industry through any kind of fiscal measures? All of you are talking about the need for fiscal stimulus at this point in time, but can the government afford it?
I think it is a bit of a challenge. There is no doubt on that. But our recommendations today when we met the finance minister and his team was also areas how to increase revenues. So I think that is one area by which they can increase revenues. For instance, this year the target of disinvestment inflows into the government accounts have not been based on what the budget was. If that had happened, they would have got additionally 40,000-45,000 crores. We are suggesting for the next year, please have a budget of 60,000 crores.
But Mr. Sriram, let's discuss this disinvestment issue, because it doesn't seem likely that the government will be able to meet the disinvestment target set for this financial year. Now, given that situation, I know CII has pegged an even more aggressive disinvestment target for the coming year. Do you believe that is this a case of the government mismanaging the disinvestment schedule once again? We saw the previous government do it. Do you believe that this government is guilty of mismanaging the disinvestment schedule as well?
I think there is always a little time it takes to come to the stage of implementation. I hope and I feel it is a situation of planning for the disinvestment. The markets are still buoyant. The mood about India is positive across the world. So I'm confident that they will look at the disinvestment in the new financial year in a more aggressive manner.
Okay. Mr. Sriram, the budget session will also see action related to the goods and services tax. The initial feedback on the rates is that it will be significantly on the higher side. What, according to CII, is the ideal rate for the GST that will take care of the interests of corporate India, states as well as the centre?
GST is something which we are absolutely behind, and we appreciate the effort put in by the FM and his entire team on that. Our judgment says that to have a wider base for GST, two things. One, we should virtually bring it on all products and services, because that then ensures it's wider. And secondly, the rate should be lower than the calculations which show the state and central averages. That comes to about 26+%. Our feeling is GST should be in the range of about 20%, because that will then be accepted better, adherence will be better, and with a wider base, within a short period of time, I think the inflows into the government coffers will go up.
Well, Mr. Sriram, thanks very much for joining us on India Business Hour. Let's see if the Finance Minister obliges you and attends to that wish list that has been presented by industry chambers today. Appreciate you joining us here. With that, it's a wrap on this show. Thanks very much for watching. Stay tuned to CNBC TV 18. The news continues.
CNBC TV 18, celebrating 15 years of leadership.